Hello, everyone. Welcome back to How to Trade. I'm Shane Vernier, and this is FOMC Live. Today, we're going to be breaking down probably one of the biggest interest rate decisions we've seen, at least this year. As of right now, the Fed did not do anything to interest rates, but it's the devil's in the details. We're going to watch Jerome Powell's presser. We're going to see exactly how Jay decides he's going to approach these markets and how he's going to approach inflation and that dual mandate of balancing maximum employment along with pricing stability. So a lot going on in the markets right now. Excuse me. We're seeing really whipsaw action, which it should not surprise you if you're trading U.S. equities. Whipsaw action all over the board. I'm watching gold closely. Those of you that follow me on X at ShaneV_trader, I get the question a lot. How much money do you trade? How much money do you make? What kind of positions do you take? I posted some of my results from late last night trading gold. It was a big night, and I'm absolutely happy. So if you guys are not concerned, but if you're curious about some of the size I trade for real, I showed you a little bit about what a trading session looks like when things are clicking, and everything was clicking last night. And I was trading intraday gold right around the London Open, absolutely killing it. Right after the Tokyo probably late Tokyo session, right at that London Open. And I'll tell you what, gold futures were absolutely on fire, and it was a situation where the Fibonacci's they killed it. They absolutely crushed it. So I'm very, very pleased with how things have been going over the last 12 hours or so. Full disclosure, yeah, I was up till about 3 in the morning here. I got a little bit of a cat nap this morning, and they got right back in front of the charts and the screens because we have a tremendous amount going on. Now I see pretty much everybody's here. A lot of familiar faces. Good to see you. Yes, sir. Always a pleasure. Sent Hill. Apologize for the names in advance. Loof. Good to see you, Loof. Henry. T. Marina. Good to see you, T. Amir. Francis. What direction is the market heading? Well, we're going to talk about it a little bit. Brian Barbie. Hey there. Hey, Brian. How you doing? Good to see you. A long time member, Dibble. Dibble's back in the house. Good to see you, Dibble. I hope everything's going well in your neck of the woods. I know that this is a challenging year, and it really is a big challenging year. So I have to start with the 10,000-pound elephant in the room. And I mean, this is a really big deal, guys, because I'm waiting for this to go really anytime. Good evening from Botswana. Good evening to you too. Clive Harrison on my way to CheckX. Check it out, Clive. You won't be disappointed. Just take a look at my thread. And I was posting late last night. I posted some pictures of my P&Ls, and they're legit. Believe me, I don't come here to lie. They're legit. In any case, Andy, good to see you. Do you do MGC? Not really sure. MGC. No, I don't trade micro gold. I trade full-size gold, and last night I was trading 3 and 4 lots. So it's pretty good stuff. Euro, good to see you. Alita, always a pleasure. All right, guys, let's get to it. We've only got about 9 minutes until Jay Powell comes out here. This is the story right now. I'm watching this very, very closely. We're talking about a potential war escalation here with the U.S. hitting Iran. I talked a lot about it yesterday. I can't really talk much about it today because we're all about policy and FOMC Live. We're going to talk about Jay Powell and what he's going to say. But right now, this is a delicate situation. It looks to me like the U.S. is going to do it. I predict, my own prediction, tomorrow's the Juneteenth holiday, which means the markets are going to be closed. And I'm telling you guys, as sure as I'm sitting right here, that more happens when the markets are closed than when they're open. So if we're watching and we're trading, we've got to remember that market closure is going to be tough on those traders that go home either long or short. I don't know that anybody's going to want to go home long risk assets into tomorrow's market closure, but they will come back and trade it with a vengeance on Friday. Now, there's a lot going on here. We pretty much believe across the board that you're going to see U.S. airstrikes on Iran, and I don't know. I'm going to hold back my opinion on what I really think about that because it's not important. What is important is that we know what's coming and that we're bracing ourselves and getting ready for it. Now, this is big here. This just broke. These have been breaking over the past couple of days, but this just broke about 6 hours ago. We're seeing the Strait of Hormuz, which is essentially a huge, about 10% of the world's energies go through the Strait of Hormuz every day. We're seeing jamming signals coming out of Iran that are jamming the oil tankers' navigation systems, and we're starting to see collisions. This is going to escalate. My guess is when the U.S. actually starts bombing Iran, the Strait of Hormuz will be shut down. That's going to impact crude oil. It's going to send it high. Now, listen, I've heard a lot of guys talking, a lot of traders talking today, and they're saying, hey, we're going to see $130 crude. We're going to see $300 crude. I heard $300 crude oil today. And I said, not so fast, my friend. It's not going that high. When this breaks, we're at 73 right now. We're going to make a run at 100. I would almost guarantee it. Now, the problem that we have is we can't really time it because I don't know when it's going to happen. Believe me, if I knew exactly what was going to happen, I would tell you guys just to show up and buy WTI at XYZ and then pull back and just take the money. But we don't know. We just don't know We don't know. So right now I'm on high alert. I've been, like I said, I've been up for a long, long time, but that's the trading game. When you fall into a rhythm, you don't want to leave the markets. You want to just keep trading. This is the story right now, though. This is where we got to talk about some monetary policy. The Fed holds key rates steady, still sees 2 more cuts this year. That's big. We're still calling for 2 cuts, so we're thinking that we're going to go into New Year's, we're going to go into Christmas and New Year's Eve, and we're going to have a prime rate, a federal funds rate that's going to be under 4%. I'm not buying it. I don't believe it. I don't believe that forward guidance. I want to hear what Jay Powell has to say. I think that he's going to back off of that big-time dovish market call. So I do want to just go right to gold because that's really a tremendous amount of money last night was flying around in the gold markets. I was shocked at how much participation was there during that U.S. overnight. And what I will say is that it was good. Oh, boy, it was good. But this right here is complete rotation. You remember I was saying, hey, listen, when we break above this high, May's high, more than likely we're going to run at 3,500. Well, this is why we have to have great trade location or else things just don't mean much. You don't get a clean break very rarely over a key level. We did not get it here. We got a nice break here. We pushed a little bit higher, and now we're retracing. So for me, I want to make my mistakes to the long side of the gold market. I don't want to get caught short, and the reason why I don't want to get caught short is because we have war. I mean, they're beating the war drums on the horizon, tremendous amount of geopolitical uncertainty. If, in fact, the Fed does decide that they're going to cut interest rates at some point this year, maybe twice, that's going to fuel inflation, as is the war is going to fuel inflation, as is higher crude oil prices is going to fuel inflation. You see where I'm going with this. Gold is the number one inflation hedge aside from some agricultural commodities. I won't get into that. That's very complex. There's lots of folks that take a corn, soybean, straddles and strangles and things with options contracts to beat inflation. You got to be a rocket scientist to do that, and I am not. But what I do know is this: the metals markets will respond positively to these types of stimuli. Now, what could crush gold? Well, a hawkish Fed, a Fed that maybe wants to raise interest rates instead of cut. We don't know. Maybe it's a possibility. And then also a peace deal. I mean, if we see Trump hit center stage and say, okay, the bombing raids are off, we've got a new nuclear deal with Iran, unconditional surrender, then that will bring gold way down. It really will. That's a big not so fast, my friend, though. I don't know. Let me see. Let's see. Hayne, good to see you, Hayne. Euro. See ya. Korea. Let me see. I'm sorry, Selvin. I'm just going to have to go with the names I can pronounce. Emmanuel, good to see you. Buy Euro USD. We're going to scalp the Euro USD during this release. I'm going to show you exactly how. Let me see. Hi from India. Good to see you, Swornoff. Always welcome. KM, how about the DAXI? Well, the DXY really is our sort of our North Star metric. It's our compass. Anytime we want to decide what the markets are going to do, typically it all hinges on the DXY. And right here you can see we've been in an absolute free fall really since Donald Trump took his oath of office there back on the 20th of January. The dollar has just been getting absolutely destroyed. So if we were going to step back and take a big look at this DXY and say, Shane, where are we though? I mean, where is it? There's no question about it. We're in a downtrend. The dollar's losing a tremendous amount of puff. That's a key level right there. I would be keeping a close eye on April's low. Something like that right there and then right there. So that zone right around that 97, maybe 98 flat, that's a big deal. For me, I would want to sell any retracement that we could possibly get. Let's walk this back to a weekly chart and see if I can go ahead and develop a level for you. Something like this. This is exactly what I would be looking at going into Jay Powell's presser. You got to sell it. You really have to sell the dollar right now in any chance you get. Aside from one of the trade ideas and some of the scalping that we're going to do, from a macro perspective, if you were playing the DXY, you've got to be looking at 99.25 sells. I really don't see, I just don't see being able to step up and buy this thing with any confidence right now. Excuse me, throat's a little raspy. That's what happens when you're up till 3:30 a.m. Let me see, Sky Kid, good to see you. Miami-Dade in the house, man. You know what? I was actually fixing to get down to Miami here relatively soon. Never been to Miami Beach. I want to go check out Miami Beach. Never been. I hear it's great. I hear it's a lot of fun and a great city. So you're absolutely welcome. Let me see, Echo. Hi from Uzbekistan. Well, man, boy, I'm not sure I'm going to get to Uzbekistan, but that's fantastic. Thank you for joining us. We have a global community here. Be sure you ask any question that you may have. Okay, so that's the DXY. I do want to go over just a few things here. Remember, if you want to trade any of the ideas that we talk about and or strategies, check out switchmarkets.com. They've got you covered for international clients. If you're here in the United States, go to How to Trade, reach out to me, and I'll give you the name of a broker that can get you involved in the FX and or futures markets. Feel free to just reach out. Week 25, it's all about interest rates, guys. We're just going to go ahead. We're going to go pedal to the metal. Tuesday, Wednesday, Thursday trade and trade hard. And boy, that's what I've been doing. And I feel pretty good about it, even though a little bit of sleep deprivation. Trade follow-up. Is it time to buy the Kiwi? Well, I mean, for me, I really like this pair. This is one of my favorite pairs to trade. And that 59.95, we've got a big-time key level right there around 60 even. And I think it's going to be a pretty good one. So I'm watching that relatively closely. As far as what we're going to be doing, this is a 5-8-13 crossover on a 1-minute chart. We're going to be watching that in the Euro USD. And then also I want to take a look at some U.S. equities futures right there. You've got your YM. You've also got your ES and your NQ. We'll probably be looking a little bit at this NQ on a 1-minute chart. Okay, I'm going to go ahead and this is our coded 920 EMA. Remember, gold means buy, purple means sell. And right here it looks like we're going to have a buy signal as Jerome Powell takes the stage. So before we go any further, I got to do a little bit of housekeeping here and see if we can get our J Powell up and running. And we should be able to hear it. Tell me if you can hear the elevator music. Just a quick thumbs up would be great if you guys can hear it. Should be able to hear it when he talks. I believe we're up and rolling.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate.
Everything is flat.
Within PDFP,
markets
growth
are
of
flat.
Consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March. In the labor market, conditions have remained solid. Payroll job gains averaged 135,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March. Inflation has eased significantly from its highs in mid-2022,
Gold's flat,
but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026 and 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term
Nobody's thinking about tariffs right now.
Anchored.
They're not thinking about tariffs. They're thinking about war.
Longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, the same as projected in March.
It's 2 rate cuts.
The median projection declines to 3.6% at the end of next year and to 3.4% at the end of 2027.
That means there's only another rate
higher
cut
than the March projection.
Wow.
These individual forecasts are always subject to uncertainty, and as I've noted, uncertainty is unusually elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on issues related to assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy strategy and communications. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up any modifications to our statement on longer-run goals and monetary policy strategy by late summer. After that, we will consider enhancements to our suite of communications tools, including the SEP.
So they're going to change all their metrics this year.
2 goals for monetary policy.
That's
maximum
cute.
employment and stable prices.
That's cute, Jay.
We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission and we at the Fed will do everything we can to achieve our maximum employment and price stability
Everything
goals.
we do it
Thank
for
you. I look
you.
forward to your
Give me a
questions.
break, Jay. All right, we're working a 1 minute 9:20 crossover buy here on
Thank you.
gold
Colby Smith
futures.
with the New York
August
Times.
gold futures.
To what extent has the more limited impact
get this
from
crossover,
tariffs
I'm
at
bidding.
this stage on inflation changed your view on what the ultimate economic fallout will be from these policies and the timing of when they will materialize in the data?
I don't know, Colby. Good
So,
question. He doesn't
we've
know.
had 3 months of favorable inflation readings since the high readings of January and February, and that's, of course, highly welcome news. Part of that just is that services, core services, both housing services and non-housing services, have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effect of tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is
don't
why
ask
we
me,
think
I don't know.
the appropriate thing to do is to
doesn't know.
hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
This is very choppy.
In terms of how we should
We're looking at the
interpret the
920.
rate cuts penciled into the SEP, is this reflecting that there's this expectation that
5, 8,
underlying
13,
inflation will
US
just stay
oil,
well enough
maybe a
contained
sell,
that
1 minute
allows the
chart.
committee to eventually move ahead with those cuts? Or is it about responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So
Good
if you look at the
question.
forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And, our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem.
Yeah, but how could you
And
say that after
will depend
COVID?
on the size of the effects, how long
I mean,
it
you
takes
guys
for them to come
destroyed
in,
the
and
monetary
ultimately
system
on-
after COVID.
on keeping inflation expectations anchored.
Yeah, T, absolutely. That was a terrible answer. Jay's 0 for 1.
Hi, and thanks
Ask him
to
an easy
Chairman
one.
Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjust it over the full time horizon you've got there, you've taken about a quarter point per year out of your projected path, and you end at a higher rate at end 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will
Gold's
lead to
gonna
more
move.
persistent inflation?
It's loading
Is it
up.
a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
Yeah.
So I would focus most on the nearer term as you get out to the later years. It's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April, after the March meeting, that substantially higher tariffs were likely. And then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So
Good
what
question.
we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated.
Uncertainty
Many
is
surveys say
risk, Jay.
So, and
It
that's-
is risk.
That's actually a line from the Teal book, which you can see in 5 years.
That's a line of BS is what that is.
Remember to check that.
Maybe the world will be.
He knows he's lying right now.
No, but if you think about it,
Come on, let's get our crossover.
Uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's
Yeah, exactly,
diminished, but
T.
still elevated.
They're gonna adjust them
It's
all.
uncertainty. So I think that's an accurate statement.
I think it's a nonsense statement, and you know it.
Thank you. Chris Rugaber, Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back to roughly 2% despite the tariffs. And I guess I also wanted to ask about cracks in the job market with gross hiring slowing, concentrated in just a few
Okay,
industries.
here's our cell setting
We've
up here in
seen some
U.S.
housing
oil.
data, including this morning, that have been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates going forward?
So we do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual
That's
flows
right,
in the
Brian.
first quarter, but it appears to be 1.5–2%, maybe a little better than that. Sentiment has
Good.
come up.
We're working our
off of
5, 8,
its very
13
low
crossover,
levels. It's still,
just like we did
still
yesterday.
depressed. So
Gotta get that cross.
you can point to things. The housing market is a longer run problem, and also a short run problem.
Yeah, inflation
I don't think
hurts
it's
them here.
indicative of basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very, very slow continued cooling, but nothing that's troubling at this time. But we watch it very, very carefully. So overall, again, the current stance of monetary policy leaves us well positioned
Okay,
to respond.
we
in a
haven't
timely way
yet
to
crossed
economic
over just
developments,
yet.
for now, and
You got to
we'll be
wait one
watching
more
the data
minute.
carefully.
If this
Well,
kicks
just
up, this
quickly
crossover
on,
won't happen. You got to wait.
Given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do
Yeah,
you
gold's
see
flat right now.
odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation?
Okay, this is going
would
to
you
be the
need to
short
see
in U.S.
before
oil.
concluding that maybe that lower inflation scenario is
20
taking
seconds.
place?
So this is very much the conversation
I
we
want it
had
to go too
today
far.
and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a
All right, here we
time
go.
of very high uncertainty and writing down
5,
what
8,
they think the
13,
most
there's
likely
the
case
sell.
is. No
Crossover,
one holds these
there's entry.
rate paths with a great deal of conviction,
Stop
and
loss.
everyone would agree
Right
that
up
they're
there
all
above
gonna
that
be
swing
data
high.
dependent, and that
Profit
you
target.
can make a case for any of the rate
Right
paths,
down in
I
here,
think,
potentially?
that you see in the SEP. And we do this once a
also
quarter.
dial it in right
it's,
in
It's
here.
a hard thing to do particularly at this time.
going
But
1 to
it
1,
does
20
reflect,
ticks.
if you
See if
see
we get
somebody
it.
writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many
back
months
to
does
gold.
it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing
This guy's
the kind
beautiful.
of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more.
Because we're in a
And
good
in particular,
place.
we feel
We're in a
like
good
we're going
place
to learn
right
a
now.
great
Look at
deal
this
more
move from
over the
gold.
summer on tariffs. We hadn't expected them to show up
3,400
much by now, and they haven't.
So get some
And we will
Fibonacci's.
see whether to the extent to which they do over coming months, and I think that's going to inform our thinking for one thing. In addition, we'll see how the labor market
33 and a
progresses.
quarter.
So
Huge
At some
support.
point, it will become clear. I can't tell you exactly.
We might
when
get
that
it.
will
You never
be.
know.
And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and it's I think all estimates are now pretty close together, but it's highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people are managing to that. But the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict. And we haven't been through a situation like
We
this.
just
And
don't
I think we
know.
have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
We have to be humble about our ability to forecast. That means we don't know. We don't know what's going to
Wall Street
happen.
Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are
Potential
putting down
buy
no
setting up
cuts,
in gold.
another that are putting down more than one.
Still short U.S. oil.
And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts, and they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, more cuts. But remember, as we see more
Potentially
data,
a
we're going
bid
to
here
learn
in
more about
gold,
where inflation is headed,
setting
and that
up.
means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So that you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things. And I
nobody
think
holds
as the
the
data
dot
come
plot.
in, you should see those differences diminish.
So basically, it was
You've
nonsense
said
what
the
they put out
policy is in a
today.
good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases
Press is
versus margin
combative
compression?
today.
Some of the softness that Chris talked about
Look at
in
Nick
labor and
Timmeros,
housing.
he's angry.
Why wouldn't it be better
Get angry,
to have
kid.
rates at a more neutral setting as the economy heads into this period of very high uncertainty?
So if you just look backward at the data, that's what you would say, but that's not. We have to be forward-looking, and the thing that every forecaster, every outside
Have to
forecaster,
use our eyes to
and the
see.
Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months, and we have to take that into account. So I think a backward-looking look would lead you to a neutral stance, but we can't. We have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen.
Flat U.S. oil.
there's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Remember, Jerome Powell's worth $17 million. And that's
Michael
just
McKee
what's
from
reported.
Bloomberg Radio
That's just
and
the
television.
public number.
Your
17
friend,
million is what he's
1600
worth on
Pennsylvania
paper.
Avenue continues to lob insults in your direction, and I'm wondering, given now that the Supreme Court
You're right,
has,
Kareem.
maybe carved out the Fed from some of the legal implications of that, whether this is just noise.
Okay,
that
we're in
the
oversold
markets and
territory.
everybody should ignore
Crossover and
until
we buy.
your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers about the outlook for the economy.
Stocks
Okay.
giving back gains.
From my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that.
We're in a good
to
place.
respond to
There
significant
it is
economic
again.
developments. That's what matters. That is what matters to us.
That should
much
be a
that's
drinking
all that
game.
matters to us.
Every time he says we're in a good
I
place,
need
you
to
drink.
ask, assuming you are not reappointed, would you stay on as governor when your term as chair?
No.
ends?
I'm not thinking about that. I'm thinking about this.
Yeah, you are. You're gone by the end of the year.
Thanks, Mr. Chairman. I guess with workplace raids picking up significantly, what kind of effect would that have on the labor market in
Sorry,
the short
with
term?
what picking up?
None.
Workplace raids.
So you're asking immigration.
Yeah.
You know, I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means, like, part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could elaborate on the potential changes to the SEP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement.
Might get
And
stopped out
we've
here
said
on
that
U.S.
we would
oil.
finish that and announce
Possible.
it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into, discussions about specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices.
Uh-oh.
And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting,
fall.
though,
Why
is
don't you do it
we sort
tomorrow?
of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SEP is part of it. Many other ideas. It's sort of, how do we think our communications can be
Stop
improved?
loss is up there about
There are a number of
71
ideas.
Amir.
People offered a really
See what's the high there,
it was a
70.
great conversation.
Let's put this right up
Number
here, right
of
around
ideas, but we're
73,
gonna look at
something like
those with
that.
staff briefing and a lot of thought.
You could put it over
in
76
the
if you
fall. And I
wanted.
would
If
say
you
when
wanted
it
to be
comes
safe with it.
changing communications,
Something like that.
I would only support things really that have
yeah, it's
only
losing.
implement things that
It's
have
tough to
very
short
broad
oil right
support.
now.
And also, you want to be really careful because I think our communications are pretty
We're not
well
out of it yet,
received. They're
though.
not broken. So more is not necessarily better, but better is better. So we're going to be looking at ways to do things that will improve the clarity of what we do for the benefit of the public.
Thanks, Chair Powell. Kelly O'Grady, CBS News. You're famously known as the guy that makes decision based on data instead of speculation. You said today the inflation data is in a good place. We don't know how tariffs are going to impact prices going forward. That's uncertain. But I've got to go back to the last time that you cut rates in December, and there was still the what if of tariffs. So what made you feel comfortable cutting then when inflation was higher than where it is today and you didn't cut today?
Oh, yeah.
The
Good
forecast
question,
for
Kelly.
inflation
Go
in
get it.
December was 2.5.
She
Core
got
PCE
him.
for 2025,
She got him.
The forecast was 2.5%, which was a good inflation forecast. I think what we've learned is that, and this was long before we had any idea of what the actual policies would be. We've learned that tariffs are going to be substantially larger than forecasters generally thought, and we don't, our forecasts are generally not particularly
Not
different
good.
from those of other, well-resourced forecasting operations. So, what we learned, and particularly in April, was that
trend line's setting
very
up there in
substantially
U.S. oil.
larger
We're not out of
tariffs
that
were
yet.
coming, and that would mean higher inflation. That's what happened, and so
Take a
now
look
you
at our
see
buy.
you saw 2.5% forecast in December. You saw 2.8%
Looking to buy
in
gold.
March, and you
Just
see
waiting for a
3.1%
crossover.
now. So it's 0.6 higher inflation for 2025, and that's a big part of the change, and that's due to the effects of the tariffs that are, we don't know where they're going to land, but it's pretty apparent they're going to land higher than outside forecasters were really guessing at the end of last year.
My follow-up to that, I think consumers, right,
Oh,
we're
there's
looking
more?
for relief on rates when it comes to mortgages, car
Now she's
loans,
gonna
small
kick him in the
businesses
face
want
while
to
he's
take out more
down.
manageable loans. When you look at the cumulative inflation over the past 5 years, prices have risen over 20%. It's been a rough road.
Sure
So
has.
what is the tipping point then for the
Wow,
wait
gold
and see
falling out of
approach
bed.
in terms of how much it's going to help versus when it hurts the American consumer?
Well, I mean, we're trying to restore price. Best thing we can do for the public that we serve is restore price stability. If
And you haven't been able
and we
to do
will
it since
restore price
COVID.
stability, meaning 2% inflation on a durable, sustainable basis. That, and also maximum employment. If we restore those things, that's the best thing, and that is our goal. The best
Okay,
thing we
so
can
do
do
it
for the
then.
American people, for households and businesses, that is the ultimate thing that we can deliver. And they can make their decisions without having to think about inflation all the time. So in the meantime, we have to keep rates high to get inflation all the way down. They're not very high, let's be honest. I would say policy is modestly or moderately,
gold
probably
sell
modestly
back
not
there.
restrictive. If you look at the economy,
About a half
it's not
hour ago.
performing as though it
Sell,
were performing
stop,
under very
break.
strict monetary policy, very restrictive monetary
Pretty good
policy.
trade.
So I would say probably modestly restrictive.
Now we're looking
And
to
so what it
grab
will
the
take
bottom
is,
and buy
is
it.
confidence that inflation is coming down. Now, I would say without tariffs, that confidence would be building because if you see
that it's always
what's
past the
happening
buck
with
to tariffs or
non-housing
supply chain
services and
issues.
housing
Next
services,
time it'll
which
be
are the
Iran.
other two big pieces other than goods. Those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence
Like
how
stocks
we should
are
react
negative and
until we
trending
see
south.
really the size of the effects, and then we can start to make a better judgment. So
US
that's
oil?
what we're doing, and I think we can take
got
the
a
time
chance
to do
here.
that because unemployment is 4.2%. Wages are
Here we go.
moving up. Real wages are moving up at a healthy clip now, and inflation is 2.3% headline inflation over a 12-month basis. So it's a good economy and a solid economy.
Well,
with
yeah,
decent
if you have
growth.
17 million in the bank, it's a good economy. XAU USD, we got to be watching
Thank you,
33,
Chair
probably 33.30 to
so you're saying that
33.25.
uncertainty has come down.
We might
the
get it.
economy's moving at a
We
solid
might get
pace.
it.
Inflation has come down over the past 3 months.
Gold's crashing right
and this
now.
is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
Yeah, it's
I'm
going to be a
not
recession.
saying
Say
that
it.
at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy
We're in a good
level.
place.
Unemployment,
That's another
again, as I
drink.
said, low. Labor force participation in a good place. So, and what we're waiting for
Told you,
to
we're in a
reduce
good
rates
place.
is to understand what will happen with really the tariff inflation.
All right, is this our buyback?
And there's a lot of uncertainty about that. Every forecaster you can name who is a professional, forecaster with adequate resources and forecasts for a living is forecasting pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs because someone has to pay for the tariffs, and it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer.
Yeah, but if the exporter eats the
ultimately somebody
tariff,
putting it
that
into
doesn't
a good
translate
of
to
some kind, or
inflation.
just the consumer buying it.
It doesn't. It means
know,
they
and
just
all
fall on
through
their
that-
sword.
That
They keep doing
chain,
business.
people will be
He
trying
knows
not
that.
to
He
be the
won't
ones
say
who,
it.
who pick up the cost. But ultimately, the cost of the tariff has to be paid, and some of it will fall on the end consumer. We know that because that's what businesses say. That's what the data say from past. So we know that's coming, and we just want to see a little bit of that before we make judgments prematurely.
Exactly.
Follow
What
on,
do you
so
forecast,
You spent
Jay?
years ago talking about how
You're the
how
PhD.
data dependent, and be a little more direct on this. Now you're making decisions looking forward. Doesn't the data you're seeing today indicate there should be?
Boy,
a rate
they're rough on him
No, I
today.
mean, your monetary policy has to be forward-looking. That is elementary. You've got to be looking. I always talk about the incoming data, the evolving outlook, and the balance of risks. That we say that over and over and over again, right? So it's always forward-looking. If you know, at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad, right? So we took very aggressive forward-looking because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not
U.S.
crying
one's
out
flat.
for a
I don't know
rate
if we
cut.
get a move at all there.
Businesses, were in a bit of shock after April 2, but you see business sentiment, you talk to business people now, there's a very different feeling now that people are working their way through this, and they understand how they're going to go. And
All right, 5-8-13, US 500.
Constructive than it did 3 months ago, let's say. So, again, we think that our current stance of monetary
Oversold.
policy is in a good place.
This crossover has to develop. Price has to be above all three moving averages, and we can go long.
Thank you. Amara Mokwe with Bloomberg. Chair Powell, in February, you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to staff in May announcing a deferred resignation program at the Fed, you said you wanted to ensure that the Fed was, quote, right-sized. Those two statements appear to be at odds with one another. Could you explain what changed in the roughly 3 months between those statements that made you decide
About
that
20
staff
seconds,
levels
and this
at
is
the
a
Fed should
bid,
decline?
US 500.
I don't see them at all as intention. So I was asked, is the Fed overstaffed? And I said no. And I sort of said as a pun, overworked but not overstaffed. People do work extremely hard at the Fed, and I know they work hard at Bloomberg too. So, but we do. We work hard, and
No, you
but I would
don't.
say this. So
Coal miners
we are
work
careful
hard.
stewards of
Okay, there's
public
your
resources,
crossover.
and sometimes you need to show that.
Send 'em.
So there have been several times in our history, modern history, where the Fed has said, you know what, we're going to do a buyout. We're gonna show the public. We're gonna demonstrate that we are good stewards of public resources. So we thought, and I thought that this is a time when we can, we grow at about, our headcount has grown at about 1% a year. So over the course of a couple of years, we're doing a careful scrub of the board and all the reserve banks, and we're going to find 10% of employees who can do something else,
71,
where we can
16.
streamline our operations, and we
03.
think we can get there in a couple of years. We think we can do that, and we think this is without taking risk to carrying out our critical missions. So this is something you do very carefully, thoughtfully, and you do it, again, respecting that we have critical missions to carry out.
This is tough
I've had
crossover trading. The
experience,
markets
a lot
aren't
of
doing
experience
anything.
in my prior careers, with
See how that
headcount
goes.
reductions and things like that, and this is how you do it professionally. You do it carefully, thoughtfully, with a lot of planning, and you do it over a period of time.
Then you cross
I
your
think it's-
fingers and
I think
hope
the
you're
Fed will
right.
be fine. I think no one will notice any decline in our ability to carry out our missions. And I think it's just us wanting to demonstrate to the public that we are actually good stewards of their resources.
Yeah.
We're
It's
effectively
complete word
wiping
salad.
out 10 years of
He's
headcount
talking in
growth
circles. He's worse than
with
me.
this. So, I mean, we wanted to show that, that we're good stewards.
How is progress on reducing headcount going so far? Are you on track to meet the
Not
goal?
that
We're
good.
just at the very beginning. As you know, we're doing a buyout program. We're gonna hit that goal. I think many organizations find that they can do this. You don't want to do it every year or anything, but you can do it at intervals, and you wind up not interfering with your ability to perform your jobs.
Chair Powell, Claire Jones from the Financial Times. As you're no doubt aware, the Senate Finance Committee has tabled its version of the reconciliation bill this week, and I was wondering if you could tell me a little bit about the tenor of the debate at the FOMC over the past few days on fiscal policy and the degree to which that influenced people's projections for 2026 and beyond. Thank you.
Yeah, so, we don't sit around and debate or really discuss. We take fiscal policy as fully exogenous. And
exogenous.
So we actually really didn't talk about the bill or the contents of it. It's still evolving. When it gets closer, remember also we have a very, very large economy, and that the effects will be at the margin. I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate, but it's not a major thing.
Gold's
it's nothing
interesting.
that we discuss.
Might be a pretty good
it may have
late
been
day
mentioned a couple
buyback
of times, but as something that's coming in,
especially going into the market
but
closure
I think the outcome
Juneteenth.
is, we
It's
don't
not a
know
bad
the outcome
play.
yet there, so hard to be real specific.
U.S. 500's down. We're gonna get stopped there. U.S. oil, nothing's happening. This is choppy whipsaw stuff.
Neil Irwin with Axios. There have been some cutbacks in economic statistics collection in the last few weeks. Worries that long-running problems around funding and response rates may be getting worse. How much is this concern on your radar? How much confidence do you have that the gauges you're watching to assess the economy are reliable right now?
Two things. One, the data we get right now, we can do our jobs. I'm not concerned that we can't do our jobs. That's not the point. The point really is that we are starting to see layoffs and important gatherers of data are saying that they're having to cut back on the size of their surveys. That's going to lead to more volatility in the surveys. I think we should take a step back and, from our standpoint, and I think the standpoint of businesses and governments and everyone, having really good data on the state of the economy at any given time is a huge public good. It helps, it not just doesn't help the Fed, it helps the government, it helps Congress, it helps the executive branch. More importantly, really, it helps businesses. They need to know what's going on in the economy. The United States has been a leader for many, many years in this whole project of measuring and understanding what's happening in our very large and dynamic economy. And I hate to see us cutting back on that, because it is a real benefit to the general public that people in all kinds of jobs have the best possible understanding of what's happening in the economy and hence what's likely to happen. It's very hard to measure what's going on in the U.S. economy. If you read, there was a book called, it's really remarkable how many things you need to understand to estimate U.S. GDP. Very, very difficult, and it's so important that we get it right. I just would say it's not a place to I would want to keep investing in that, for the good of the general public.
Victoria. Hi, Victoria Guida with Politico. So you're conducting this monetary policy strategy framework review, but next year we're supposed to have a new Fed chair, and I'm wondering if that affects at all the way that you're approaching this. How do you ensure that this framework will actually be durable?
The framework document goes back to 2012, and it's the committee's document.
Here we go.
It's not like we're going to invent a brand new way to do things. It's been an evolving document, so it shouldn't depend on who the chair is at all. It should depend on what's happening in the economy and what the committee wants to do. So, yeah, it isn't really tied to any particular chair. And we used to renew it every year. Now we do it every 5 years. So, but I don't think I've never heard anyone raise this issue that a new chair might want to come in and go in a completely different direction. I really don't think that's right. But but that's not going to be up to me to decide.
Sure isn't.
Is that affecting at all
Fired.
who you're consulting with?
Not at all. Not in any way.
You got to be getting to the last question here. This is a marathon.
Thank you. Chair Powell, Matt Egan from CNN. Relatively low gas prices this year have helped drive down inflation in recent reports, but that trend is starting to reverse given the crisis in the Middle East. How are you thinking about how the Israel-Iran conflict will impact the economy, especially inflation? And what lessons were learned during the 2022 period when another conflict, the Russia-Ukraine war, sent oil and gas prices skyrocketing?
So, of course, we're watching like everybody else is, what's going on. I really don't have any comment on that. Possible that we'll see higher energy prices. What's tended to happen is when there's turmoil in the Middle East, you may see
Holy
a spike
cow,
in energy
US
prices,
oil
but
just
it tends to
exploded.
come down. Those things don't generally tend to have lasting
something's
effects on
happening right
inflation,
now.
although of
What
course in the
happened?
1970s
Breaking
they
news.
famously did, because you had a series of very,
What, did
very
they drop a
large
bomb?
shocks. But we haven't seen anything like that now. The U.S. economy is far less dependent on
Look at this.
foreign oil.
That's U.S. oil?
Than it was back in the 1970s. So, but there.
A quick follow-up. I've just got to ask you about artificial intelligence. Some
what's going
technology
on with the
executives
oil
have
market?
recently
Does anybody
been
know?
warning that AI could wipe out a large chunk of entry-level jobs.
Yeah, what just
and
happened?
significantly increase the unemployment rate. I'm wondering how concerned you are, if at all,
Something
about
just
the threat
happened.
that AI poses to employment.
That's incredible.
So this is the question. Question really is, will AI be more augmenting labor or replacing labor? And I wouldn't, we all see those announcements, including one today. I wouldn't, overread.
There it is. Trump says U.S. may or may not join
data
Israel's strikes
points,
against
because,
Iran.
AI should
9
be
minutes
creating
ago.
jobs at the same time. It may be replacing, it may be doing both.
This is the
Anyone
world we
who's
live in.
done any work with it, with
We
AI,
wanna sell.
will have been a little bit
Good.
stunned at how capable it is. And it's just a different thing. So I think this is something that certainly has transformational potential. And probably we're in the very early stages of it. They say what you're seeing now compared to what you'll see in 2 years is going to be very different and even more effective. So I think it's really hard to know. That, of course, there are optimists who feel like it's going to make everybody much more productive. And there are those who think it's going to replace an awful lot of jobs right across the income spectrum, white collar, blue collar, and everything. So I just don't know.
Wow, this is
we
crazy
don't have
action in
a
oil.
house view on that.
Crazy.
But this is going to be a very important question for some time.
Markets are hinging on every word out of Trump's mouth. Right now, Trump says nobody knows his plans on Iran. He may or may not order U.S. forces to attack.
Greg Rapp from Market Watch.
Nobody
I was
knows what
wondering
he's
if you
going to
could
do.
Step back a little bit, Chair Powell.
Wow.
There's a spate of articles and a lot of op-eds now in the newspapers saying that the U.S. economy and the global economy is going through this profound change, akin to the end of the Bretton Woods era in the 1970s. And don't you owe the American people some sort of explanation for what we're going through? I mean, I noticed earlier this month when you talked about Bretton Woods a little bit, and you said that Bretton Woods, the Fed staff had to change how the dollar movements of the dollar was impacting the economy. Are we going through something like that now? That are you having to change how you do monetary policy? Is it that fundamental a change underway? Thanks.
It's certainly a time of real change. From a geopolitical standpoint, from a trade standpoint, from an immigration standpoint. You see this not just here but everywhere. So there's quite a lot going on. It doesn't change the way we do monetary policy in the near term. But and it doesn't change our objectives or what we need to do. And these things are not really our issues. They're really issues for elected governments. All of those issues are really for elected governments. But there's no question it's a time of real change, and very hard to see where that goes. Will it be? There have been many things written about how it's going to be a more inflationary time. That's possible. It's not guaranteed. AI could cut in the very other direction. AI could make people much more productive and push in the other direction. I don't know though. But you're right. But honestly, our focus is a much more practical one, and that is how do we keep inflation low and employment high in the near term. That's really what we're about.
Has to be the last question. With 47 minutes, how long is this guy going to talk for?
Hello, Chairman Powell. Mark Hamrick with Bankrate. What is the view about the growing amount of slack in the job market?
Guy's got a
including the
radio
softening
voice.
in payrolls, the forecast of a modest rise in the unemployment rate,
A modest
and
rise.
the ability of
He
workers
does
to
radio.
demand wage hikes or not in this environment where you have inflation surging?
You don't really see unemployment going up. You don't see increased slack, really. At the margin, remember, you're at 4.2% unemployment. That was, for many years, that was extremely low level. It happens to have come up off of an even lower level as we came out of the pandemic. We were as low as 3.4%, but 4.2% is probably at the low end of estimates of the longer run, sustainable level of natural rate of unemployment. So I guess I wouldn't agree with that. And also, in terms of wages, real wages after inflation have been moving up sort of more than was consistent with 2% inflation. They're still moving up at a healthy clip, and I think much more consistent with 2% inflation given a reasonable assessment of trend productivity. So it's a pretty good labor market. You're right that the level of job creation has come down, but so has the supply of workers, the change in the supply, the new supply. So you've seen the unemployment rate remain pretty stable at 4.2. It's been as high as 4.3, but those are good numbers. So it's a pretty good labor market. There's a more concerning thing is there are not a lot of layoffs, but there are not a lot of job creation. If you're out of work, it's hard to find a job, but very few people are being laid off at this point. So that's an equilibrium we watch very, very carefully, because if there were to be significant layoffs and the job finding rate were to remain this low, you would have an increase in unemployment fairly quickly. But that hasn't happened. It really hasn't happened.
Neither is our gold buy.
The U.S. economy has defied all kinds of forecasts for it to weaken, really, over the last 3 years. And it's been remarkable to see just again and again when people think it's going to weaken. Now, eventually it will, but we don't see signs of that now.
U.S. 500 back in the green.
Go to Jean for the last question.
Thank God.
Hi, Chair Powell. Jean Young.
Yeah,
with
T, there's
MNI
nobody to
Market
lay
News.
off anymore.
There's been a lot of talk about cuts. I wanted to ask you, why do you think there are no forecasts for rates to rise or even to stay where they are next year?
That's a good question,
given that,
Jean.
the projection for inflation is to rise to 3%, and there's a lot of there's some skepticism over whether those price hikes will be a one-time event.
So there are a number of people on the committee who wrote down no cuts this year, but some cuts next year. So, I think
no sleep till Brooklyn.
People are writing down their most likely path, right? They're not saying there's zero possibility of other things. Really, think of it as the least unlikely path in a situation like this where uncertainty is very high.
Oh, come on.
I think, again, people write down their rate paths, and they do not have like a really high conviction that this is exactly what's going to happen over the next 2 years. No one feels that way about their rate path. They feel like, what am I going to write down? I mean, what would you write down? It's not easy to
What do you mean, what would I write down? You guys are supposed to be the ones that handle this stuff.
We don't rule things in or out.
What would you
Certainly
write
a hike
down?
is not the base case at all. It's not
Are you
something people
kidding
are writing
me?
down. But in the meantime, we do the best we can with these forecasts. And
Do
I
better.
think they're representative of the different forecasts and different reaction functions that people on the committee have.
Try
so thank
harder.
you very much. Thanks.
All right, a couple of things we'll go over here real quick. The action in WTI crude oil. We're going to go right back to this because it's absolutely huge. I think that when we start talking about scalping and intraday scalping, especially what we're involved in right now, US 500, this looks to me like it's going to be a pretty darn good trade. You've got about 40 minutes left. If you're on the right side of this, you may want to consider taking the money and going. As far as what I would say with gold, I mean, we've been stalking this trade forever now. I don't know that we're going to get it. I thought right here we were going to get our crossover. We were deep into oversold territory, so we had a chance to maybe grab the bottom today in gold, but I mean, we're just in a free fall. We're going to look at the U.S. oil because you could have made money or you could have lost money. I mean, this is one of these things that we really call it systemic risk. And what systemic risk is, it's when things just go poorly, when something crazy happens and it shakes up the whole system. Think of it like rolling the dice at a craps table. You just are throwing it. You don't know what's going to happen. And when we say a key event that just realistically just broke while we were on the air, it had nothing to do with Jay Powell, but take a good look at this. I mean, this type of bar right here, I don't really know how to account for this. I really don't. On the one hand, if you remember, we were holding shorts. I believe we were right there. We were holding shorts right around 50, somewhere right in there, 73.49. That was our shorts. So the question becomes, does this happen so fast that our stops get run before the market reverses? Did we get any love to the downside before we got taken out? This is what I would call an occupational hazard. When we were right here, things were looking pretty good. I mean, I felt really good about it. We had a trend line, an upper trend line, spike high, and we were starting to trend down. Really felt like the bottom could fall out of this market. Now, what happens? We get a move, we get a head fake to the top, and then you just get an absolute crash. That's one of the reasons why when I'm in the live market and I'm trading decent size, I do have a stop loss in mind, but I don't necessarily have it down in the market, meaning I know where I have to get out at, but I like to give these a little bit of time to develop because this stuff right here, more often than not, is going to go in your favor. Markets just don't break against you and blow up. Typically, if they blow up, they run all the stops. We were short. We were holding shorts. We got run, and now the market just goes right down and gets the points. So, unfortunately, I don't really know what to tell you about that. There's no way to know when those things are coming because this is the culprit right here. This was 9 minutes ago. U.S. Congress says members say Gulf Arab leaders privately call for eliminating Iranian nuclear threat. And then you've got Trump right here. I may do it. I may not do it. I mean, nobody knows what I'm going to do. I don't know how we're supposed to unpack or trade that. I mean, we can't really trade it because it's just a complete outlier. So when we see a big reversal like that, you might have won, you might have lost. A lot of it depended on the spread and if you were filled at the top side before the market reversed. Because if we take this right down to, say, a 5-second chart, I mean, you see what happened. Boom. You got run, and then it collapsed within, about 15 seconds there. So that run probably knocked you out up at 73.94. You probably got knocked out right here, about 10 seconds, and then a nice spike, and then a reversal. That's really hard. I don't really know what to say about it other than you kind of just think it's bad luck. On the other hand, we also know that trading U.S. oil after that 2:30 p.m. Eastern is inherently risky. We know it's risky. And if it's risky, then we sort of say, yeah, this could be a pretty tough trade. I don't know. I liked it. I thought that the indicators gave us a good opportunity, and I thought the way that Powell was talking, there was enough volatility for us to get paid off. It just didn't work because we had a news item drop, the market goes crazy, and I mean, that's a wrap. Yeah, Team Marina, I got knocked out. Yeah, I bet. I mean, that's really tough. It's really tough. I mean, it's the way it is. US 500 starting to crater now, back to break even. I don't know. I really don't know about the direction of these markets. The trade that we really wanted was going to be this one right here. I wanted this gold trade. Now, 1 minute chart, is it still wise to be looking at a 1 minute? Probably not. As we go into the late session and tomorrow's market closure, you're probably going to want to be a little bit more careful, but like a 5 minute, very confident in this. Deep into oversold territory. If in fact we base and then rotate back up, it might not be a bad time to be taking like a spot gold long as we roll into the market closure. It could be pretty good. Let me see. Team Marina doing the leap competition on my trading view, and I lost my 2%. That's tough. My apologies, but I didn't know if I knew it was coming, I would have told you guys. So at the end of the day, this is the deal. Trump and Powell are at each other's throats, more so Trump than Powell. Powell never says really anything. Trump beats him up pretty regularly. Earlier today, Trump said Powell was stupid and he wants to appoint himself to lead the central bank. I don't think that's going to go over real well, and I don't think he can even do that. So today, the big question was the Fed dovish or hawkish? And in my view, they were neither. There was a great question. There was a great question in there from the young lady in the back, the blonde lady, and she flat asked him. She said, "Hey, listen, why didn't you cut rates now? Because you cut them in December and things were worse in December. Why didn't you cut them now?" It's a good question, and the answer is politics. He doesn't want to cut interest rates yet. Him and Trump are having a duel. They're having a standoff, and Powell knows that if he starts cutting interest rates, he's going to have to keep cutting them. In my personal opinion, and I'm an armchair economist, I'm a trader, I'm not an economist, but what I will say is that if in fact you start cutting interest rates right now with inflation not in a good place, I don't care what anybody says, it's entrenched. We're used to higher prices now. It doesn't mean that inflation's in a good place. Okay, if you start cutting interest rates right now, it's impossible for us to know how high that the prices really could go, how high that inflation could get. So for me, I mean, I saw a lot in there that showed me that the Fed is really asleep at the wheel. I would like to see them raise interest rates for the next 6 months, maybe way up there to get prices down. But that type of pain's not going to be allowed because it will force us into a recession. So remember, how does the Fed impact the Forex? If they're dovish, you're going to see bearish action in the USD. Typically, stocks rise. And if they're hawkish, you're going to see bullish for the USD. You could say that today was a little bit on the hawkish side of it. I won't do that. I think it's completely neutral. I've never seen anybody make as much money as Powell makes and just sit there and basically say, I don't know. We don't know. It's very hard. We have to be humble about our ability to forecast things. Okay, fine. You know, I'm humble about my ability to run a 4.40. I know I can't do it. Jay, are you telling us that you guys can't do it now? Or do you need to change your tools? Or do we have to rethink the way that we're doing business? What's the deal? And the answer is they don't know. And so they'll blame tariffs. If there is a widespread missile strike from the United States on Iran, it's gonna completely just tip everything over. And right now, nobody's talking about tariffs. You know, they're talking about who's going to back Iran, who's going to back the U.S. and Israel. We already saw some tough talk out of Turkey. We saw some tough talk out of Pakistan the other day. We don't really know which way all this is going, other than the fact that it seems to be borderline. I don't think it's under control. And remember, as far as the news cycle goes, you've got a market closure tomorrow, okay? You've got to be ready for anything. I have a feeling that you're going to see those missile strikes probably, if not tonight during the U.S. overnight, during Thursday's U.S. overnight. And if, in fact, that does happen, if it does happen, you're going to see major action in WTI crude. You just saw how volatile that thing can be. You could easily see crude oil run right up there to $80 or $90 very, very quickly. So we're watching the Strait of Hormuz. We're watching missile strikes. We're watching Trump for any signs that he's going to back off or go forward. We just don't know yet. And when we don't know, we have incredible volatility, and that's good, but it's also very, very risky. Very, very risky. Clive, did you see those gold results? Yeah, those weren't bad. If you guys want to see, I never post money. I never post real money because I don't want young traders trying to mimic my returns or trade the size that I trade. I'm not going to sit here and lie to you. I was trading size last night, and it was pretty good. Earlier today, I thought I had a really great trade in WTI crude futures, and I just didn't quite get filled. I think we bottomed out like at 72.36, and I wanted to buy 72.05s, and I had a lot of contracts down there. Just didn't quite get it. So today, I've sort of had it on cruise control since about, I think the last trade was about 2:30 in the morning my time. So very happy, very pleased. I'm excited for the market closure. I think it's going to be a great time for us to really regroup and get ready for the next phase of this Israel-Iran war. But I'm interested. I think that we're in for some great trading. And remember, if you're struggling with this stuff, if you're struggling getting off on the right foot, slow down. There is no shame in not even trading in this environment. This is hard. This is really hard. But if you stick with it, stick with the program, you've got your strategy, you've got your risk management, you're going to be just fine. Like today, we didn't do very well with the crossovers. You got a pretty good chance here maybe to catch that gold crossover later today. I'll be looking at a 5-minute, maybe even a 30-minute chart. But it looks like we're going to get a shot to buy the bottom. Right now, it's at 36.30, 30.63. This is the last one, and then we got to get going here. But this right here is the number. I'll be trading that right down there, right around 33.25. That's big. That's big for me. I think that that's a fantastic zone. You've got really a lot of demand. There are a lot of bidders have stepped up to the plate in the past. You can see this is just sort of whipsaw, but the bidding was really hot and heavy last week there. So I'm definitely interested in that. And we also put out our trade idea here. I'm in the Kiwi. I love this. This is coming right to us, right down around 60 even. Should be a pretty good trade. As far as, I won't give you any safe conduct. I won't give you any safe conduct. If you got to trade, you got to trade. Just understand the risks involved. You guys saw how fast that U.S. oil can move. You got to be really careful. You got to be really careful. All right, everybody, I'm going to go ahead and sign off. Hey, we just reached 100 messages today on the Restream chat, so it's good to hear from everybody. I know we ran way long. Brian Barbie, War Pigs Want War. Unfortunately, war's a racket. There's an old book that was written in, I believe it was after World War I, and I think it was Colonel Smedley Butler wrote it, and it's just this little book. It's only about probably 30 or 40 pages. But the name of the book is War is a Racket by Smedley Butler, and he goes through, and this is a guy that was a general in the Army, and he goes through and talks about how much money is spent in wars. And, the defense contractors all do very well. Unfortunately, the people, the citizens are the ones that always lose, and the soldiers. A lot of the soldiers do it as a career, but a lot of them really get put in tough positions. I know many of them that served in the first or actually the second Gulf War and in Afghanistan, and some of the things that happen in war are really tough to get over. So My heart goes out to everybody that's involved in this situation. I hope they de-escalate it, but hopes for losers and children. We can't sit around hoping. We just have to deal with what comes our way and handle what is in our sphere of influence. And if we do those things, we can be successful traders and hopefully keep our heads in what is going to be one of the craziest summers on record. You know, it just really is. Let me see, Mohammed, what about Bitcoin? All right, one last one. You guys got me going today. I'm happy. Let's see, Bitcoin. You've got 104 in Bitcoin. I love these levels. These are fantastic. You can see this pullback right here in early June to begin June. We pulled right back down to 100,000, bought it. If I'm looking at my weekly chart, I have a weekly moving average down there at 99,559, and that's my 13-period EMA. That's a 13-week EMA. I have a very, very strong opinion of my 13-week EMA. My EMAs are pretty strong, and I definitely tend to trade them. So that's right there, and that convergence at 99.50 or 99,559, right up there with 100,000. That's really an extremely just a hot bid. So if we do get this pullback down to right around 100, I would have to say I'm a bidder from 100. You might end up taking a little bit of a draw down here, maybe to 97 or 98. You could buy 99.5s. I just don't think it's going to go that low. But right now we're at 104. I'm bullish the entire way on Bitcoin. But if war breaks out and the uncertainty really spikes, then you're going to see risk assets all sell off. I don't see crypto doing very well in a geopolitical environment where you have a potential world war. And that's what we're talking about. That's why the stakes are so incredibly high. And, thoughts and, like I said, thoughts and prayers go to everybody in the region. Actually, we work with some folks that are in the Middle East right now. I know Connor's over there. You guys remember Connor? Connor's over there in Dubai, which is supposedly a safety zone. So that's a positive thing. But just everybody's got to keep their head on a swivel and be smart. Be smart. Don't go running in there with handfuls of money, guys. You got to really watch it. Let me see. T. Marina, the 1% make their banks and profit. Yeah, that's what war is. And believe me, my dad was conscripted into Vietnam. Both grandfathers fought in World War II. I had a bunch of uncles in Army intelligence. The military is big and the wars are big, and they spend a lot of money doing it. So it looks to me like we're getting ready for another war, and that's unfortunate because just in my lifetime, and I'm not that old. I'm old, but I'm not that old. How many wars? Gulf War I, Gulf War II, Afghanistan. 3 wars, 3 big ones. And the Afghanistan went about 20 years. I don't know. Who knows? Seems to be just part of the economy now. That's too bad. That's definitely too bad. All right, guys, I've gone on for over an hour. I'm going to go ahead and sign off. If you have any questions at all, be sure to head over to howtotrade.com and just send me a private message. I have a few in there that I'm going to get to right now. We did put the trade ID out. Be sure to check that. And if, in fact, you're interested in our YouTube channel, we put out a new video this week on how to trade the S&P 500, all the different ways you can do that. Not many people are watching the YouTube videos these days, and that's okay. I understand you have a tremendous amount of things to watch, but if you, in fact, are interested in the S&P, go ahead and check that out. We're also going to be launching some videos, a video series on our Switch Markets YouTube channel. And tomorrow we're going to be doing a stream on our Switch Markets. We're going to be doing our Switch Markets live stream, so you can join that stream in the How to Trade trading room, or you can head on over to the Switch Markets YouTube channel and get in on all the action there. As of right now, I'm still waiting on our gold trade to set up. It looks like our US 500 is back in the green. Our US oil trade, though, that was one that we should have got, and we just didn't get it. It's just the way it is. All right, let me see. John, this situation in the Middle East, I see this and my mind expands in such crazy ways. I'm trying to understand and succeeding. I wonder if this is the big World War III. Well, it's like the old saying goes, guys. If it's World War III, World War IV is going to be fought with sticks and stones. The sophistication of the weaponry and the amount of devastation that can be yielded right now in a short period of time really renders conventional warfare moot. I mean, I have never in my life seen so many people rattling the nuclear saber. It blows me away. People talking about surviving a nuclear war. Listen, all the studies, all the Rand Corporation think tanks, all the war games show that once one nuclear bomb is lit off or a nuclear missile is lit off, everybody lights them. And the reason why is mutually assured destruction. You don't want to be on the sidelines. It's not going to be, okay, just one nuclear bomb goes off and one area is impacted. It's going to be, okay, that one goes, and then that one goes, and then that one goes. And next thing you know, the big dogs shoot off all theirs, and there's nothing left. So nuclear war pretty much is the end of humanity. If it does happen tonight or tomorrow, you guys all have my best. I'll see you on the other side. But I don't think it will. I think cooler heads will prevail. But the conventional warfare that we're going to see here in the next 72 hours will be palpable unless Trump changes his mind. And that could be too. All right, guys, I'm going to go ahead and sign off. It's been a long time. Tuku, absolutely lead. Always a pleasure, guys. If you have anything or if you need anything, just reach out. Thank you, Dibble. I sure appreciate it. Hope all is well on your end. All right, guys, I'm out. You guys have a fantastic trading session. I would be watching the gold buyback on the 920 crossover. 5 minutes is probably good. I would be looking at the 515 or 30. Just remember, market closure tomorrow for Juneteenth. Here in the United States, liquidity will be low. Should be able to trade the Forex. Swiss National Bank gets involved overnight. Bank of England gets overnight. So if you're going to look at something Swissy and maybe the pound sterling, those are target-rich environments. Until next time, I'm going to go ahead and sign off. Well, one last comment. Let me see. Brian Barbie, even if you're at ground zero, you'll die within 2 weeks from radiation poisoning. Yeah, you know, it's really a dark thing to say, but I'll go ahead and say it. If it goes nuclear war, I hope I'm right underneath the bomb. I don't want radiation poisoning. I'm not doing any of that. So the fallout's beyond, you know, it's worse than anything ever. They said right now is the most tense time since the Cuban Missile Crisis for the United States. We'll see. We'll see. They say it's even more serious than that. I don't know. Yep. Trump will be the fall guy like Nixon. I think that's the plan. All right, guys. Have a fantastic session. Trade the action well, and we'll talk soon. See you.